Hey everyone, I hope you're doing well during these trying times. In this video, I'm going to break down my Trading212 stocks portfolio. I started this portfolio a few months ago when I saw what a great platform Trading212 was and how much better they were doing compared to their competitors such as FreeTrade. Please note I do have other investments such as peer-to-peer lending, and you should too. What's that saying? Don't hold all your eggs in one basket. I made this portfolio in late February, just before the market crash, and then scaled up the investments as the market dropped. I still have a few £1,000s on the sidelines, ready for when and if the market drops. Let's jump in and start with my US stocks, and then we'll move to the UK ones after. Stock number 1 is AMD. AMD is an American multinational semiconductor company based in Santa Clara County, California, that develops computer processors and related technologies for business and consumer markets. It has a market cap of $63 billion, and chances are, if you've used a computer or a games console, you've probably used an AMD product. AMD is an interesting pick in my portfolio as it does not pay a dividend. I've previously been an Nvidia product user, who is AMD's competitor, but over the years I've seen AMD progress, and in my opinion they are positioned to surpass Nvidia, securing multiple high-tier deals such as the previous PS4 and now the PS5, which will feature a custom 8-core AMD Zen 2 CPU. I currently have 3.02 shares with a market value of $162.48, which equates to a 5.46% portfolio allocation. Stock number 2 is Apple. I saw the opportunity to buy some Apple before the share price recovered, so I bought 0.8001 shares with a market value of $254.38. I will buy more if the price drops again. If not, I will dollar cost average into it. It drips $2.62 and buys 0.002 shares of itself every period. Stock number 3 is Costco. Costco is possibly one of the most boring businesses ever, but the business model is amazing. It is an American multinational corporation that operates a chain of membership-only warehouse clubs where people can buy reduced-price goods. Even the way the stores are designed causes more people to spend more money, and that's good for me. I currently have 0.418 shares with a market value of $128.94. It drips $1.17 annually and buys 0.001 shares of itself every period. Stock number 4 is PepsiCo, a really good company which I think a lot of people own. PepsiCo is an American multinational food snack beverage corporation headquartered in Harrison, New York, in the hamlet of Purchase. PepsiCo has interests in the manufacturing, marketing and distribution of grain-based snack foods, beverages and other products. I believe their value is better than Coca-Cola's, as Coca-Cola's price seems to be highly inflated. I currently have 1.16 shares with a market value of $152.60, and it drips $4.41 annually. Coming in with a riskier stock at stock number 5 is New Residential Investment. New Residential is the leading provider of capital and services to the mortgage and financial services industries. New Residential has built a diversified, hard-to-replicate portfolio with high-quality investment strategies that have generated returns across different interest rate environments. It is a mortgage REIT, a riskier company which has recently cut its dividend 90% due to COVID-19. I have 13 shares with a market value of $93, and it drips $2.60 annually. It also buys 0.091 shares of itself every period. Stock number 6 is one of my favourites, Leggett Platt. Leggett Platt is a diversified manufacturer that designs and produces various engineered components and products that can be found in most homes and automobiles. The bed you lay on probably has Leggett Platt springs in it, and many space-bound rockets may have components from them. Talk about diversified. I currently have 5.964 shares with a market value of $182.44. It drips $9.54 annually and buys 0.078 shares of itself every period. Now for my favourite company of all time, Realty Income. I've covered Realty Income in my previous video, evaluating my largest holding. If you want a more in-depth analysis of why I think the company is so great, I suggest you watch that. In short, Realty Income is a REIT which rents out triple net lease commercial properties, which remove a lot of the hassles that REITs have with residential investment. They also pay monthly dividends. I currently have 8 shares with a market value of $442.48, equating to a portfolio allocation of 14.87%. It drips $21.84 annually and buys 0.033 shares of itself every month. Stock number 8 is one that's been hit very hard by the COVID-19 crisis, Royal Caribbean. Personally, I think they will recover to their former glory in time. Their share price has recovered slightly to which the point that I am now in profit. Only time will tell how this company does, but every day it seems cruise line news gets more positive, which is always a good sign. I currently have 4 shares with a market value of $207.48. When the dividend is reinstated, this stock should drip $12.48 annually and buy 0.06 shares of itself every period. This is assuming the share price stays the same. Stock number 9 is one that I think a lot of people have been buying. Disney was killing it with their new streaming service, Disney Plus, pre-crash. So I decided to jump in around the $100 price point and grab 1 share. I plan to build this position up in the future. I'm aware they have cut their dividend and can only hope, now their sites are reopening, that the dividend will be reinstated soon. We've now covered all my US stocks. Currently, my US stocks have a value of $1,880.17. Now moving on to my UK stocks, and probably ones you are more familiar with. Stock number 10 is AstraZeneca. I covered AstraZeneca in my recent video on how to assess a dividend stock. They are, in my opinion, one of the best pharmaceutical businesses in the world, have recently received funding from the US, and have secured a contract to create the COVID-19 vaccine. I currently have 2.498 shares with a market value of £213, and these shares drip £7.66 per year and buy 0.022 shares of themselves every period. Centamin is an interesting pick for me. The main reason I am holding Centamin is because of its high dividend yield, and it's in the gold mining business, a business that tends to be more resilient to market downturns as it deals in commodities. I have made 50% returns already on Centamin, excluding dividends. I believe they still have further to go, and I have 60.2 shares with a market value of £102. These shares drip £5.79 annually and buy 1.706 shares of themselves every interim. I'm not going to go into legal and general in this video, but they are an insurance company in a stable industry. I have 66.7 shares with a value of £144. They drip £16.86 per year and buy 7.806 shares of themselves every period. On the Beach is one of those stocks that I'm hoping will become a 10-bagger in the future and pay a nice dividend. On the Beach sells package holidays. I jumped on the Beach as the price fell. I think it was an overcorrection as they have little employees and little debt. I have 100 shares in On the Beach with a market value of £306. They have a relatively small dividend that drips me £4 per year, buying 0.653 shares per period. I'm not going to go into my last 3 holdings in this video as they are all pretty relevant to the times we are in, but I will go over the performance of the dividends in the portfolio and the values of the portfolio as a whole. Hey everyone, so here we are in my portfolio spreadsheet. We're just going to take a look at a few things. The dividend cuts on my portfolio have reduced the annual dividend return by a lot. This was when I had less invested, when I had about £700 less than this invested, I was getting around £130 in dividend income per year. But due to all the dividend cuts and the companies that I've been investing in, a lot of them have cut the dividend, which is to be expected, and I hope they will warrant high returns in the future because they've dropped further. If we look at the industry portfolio allocation, we've got a lot in real estate. Now, this is mainly due to my Realty Income holding, which is huge. But this doesn't look very diversified, I suppose, but you only really need diversification if you don't really know what stocks you're picking and you're not that confident in the companies. That's why I see it. You see these portfolios with about 50 stocks, 50, 100 stocks, and you just think, why would you need all that? Because you're reducing your chance of losses, but you're also reducing your chance of gains. So this is my risk tolerance here. I've got 15% in technology. Obviously, it's a big growth area. Consumer staples, 18.3%. 7.2% consumer discretionary. 8.6% healthcare. 4% materials. 5.8% financials. 12.1% communication services, and a small amount in energy, as I'm really, energy has not performed very well over the past 10 years. It's been dropping a lot. It's the worst industry, I believe, for growth. If we take a look at the portfolio allocation by company, you can have a look at this if you want. I'm not going to go through all this. We're going to go look at the dividends. So if you're interested in the dividends, I started in February, so I only received 84p in dividends in February. March, it went up a little bit to £1.17. Now, this is when I'd passed a lot of my ex-dividend dates in April, and it shot up to £5.85. And I believe that was only with, I want to say, around 1.2k invested. It's not a lot. And then the coronavirus happened. So this is when all the effects of the coronavirus started showing and everyone was cutting their dividends. So we're down to £4.01 for May. I'm expecting that these dividend returns will start going a lot higher because I've been stepping on the gas, invested a lot more money. But that is yet to be seen, and I will update you on that as we progress. Anyways, thanks for watching. If you want a free share with Trading212, you can sign up with my link in the description. It's worth up to £100. Thanks again for watching, and thank you for 100 subscribers. See you next time.